Welcome to Money Hangout, our weekly interaction where we try and explain an area of personal finance, investment, and savings, help you understand something which is top of your mind. This is brought to you by Value Research and Birla Sun Life Mutual Fund. Today, we are going to talk about how to earn little more on your idle savings lying in your bank. Uh, Demonetization has brought in forefront all that was lying all around us. We have been forced to put it in a bank. Suddenly, we may not have the cash, but we have the money. We have the bank balance. Why not make it work a little harder? Why not make it? Why not earn little more on that? And it can make a huge difference. Today, it is possible. Today many mutual fund companies are offering an app whereby you can seamlessly move your money from your savings bank account to a liquid fund and get it back in your bank account on demand at will. And sometimes the money hits your bank in 5 minutes of your redemption request. It happens at with 2 clicks. Also, uh, the liquid funds are reasonably safe. They are designed that way, and your ability to move your money, earn little more. If you look at the kind of return these funds have been able to provide over the last 4 or 5 years consistently, of course, I am confident that in the coming future, the returns will not be as nice as they look in the past. But still, most of them have been able to deliver over nearly 8% return, and what you earn on the idle money lying in your bank is 4%. So if your average balance happens to be 2 lakh rupees, uh, then you would have earned you would have earned 8,000 rupees more, good enough to take care of your cable connection uh, cost for a year. Or if your average balance happens to be 5 lakh rupees, then you will be earning uh, 20,000 rupees more than what you earn on your savings bank account, the 4% usually. And likewise, if you're looking for, if you're waiting the money, a lot of money lying idle in your bank, and you're waiting for to buy that house, make that down payment, or waiting to pay the last tuition fee for your child's education, and that money has to be in good readiness to be spent anytime, you could be possibly leaving a lot of money on the table. Uh, so explore this. You can optimize return on the idle money lying in a bank, and depending on the scale of money that is lying there, it could be quite substantial.
Thanks, Sinead. But are these liquid funds 100% safe? I mean, that's the kind of question a lot of our viewers are also asking, in the sense that money in their bank accounts is, they sleep with a peace of mind that it would be available in its, 100% form as and when they need. How about liquid funds?
Liquid funds are uh, reasonably safe. One cannot say that they're absolutely safe, but they are almost safe. They are tending to be risk-free. What investors are confusing with is that I would say that liquid funds tend to be risk-free, but they do not provide you the guaranteed return. What happens in the savings bank account is that you are guaranteed the return, while in the liquid fund you are not guaranteed the return, but by their very design you are likely to earn little more. On the riskiness of it, I would say that going by the design and going by the underlying investment, liquid funds are safer than savings bank account because your money is spread over large number of securities of the highest quality and of the smallest maturity. SEBI mandates that no security in a liquid fund should have a maturity of more than 60 days. Uh, Generally, fund companies invest in the highest highest rated money market instruments only. Most of the investment that is made in by way of liquid through the liquid fund is also in the bank and the government bank CDs and government securities. So I would say that on the safety front, they might be superior to a savings bank account, simply because all your money is heavily dependent on the success or the existence of a bank, and we tend to expect that all banks are absolutely safe. The guaranteed return bit, that you are assured of earning 4%, that actually creates some glitch, itch in people's mind. I would say they are safe. They do not provide guaranteed return, and you should assume them to be reasonably riskless.
And how about the liquidity and convenience? I mean, the benchmark for people are bank accounts. Now, in your introduction on this topic, you talked a bit about the availability of apps now from certain mutual fund houses and how it adds to the liquidity and convenience. If you can elaborate a bit on that.
Yeah, one is that your ability, convenience is a very substantial thing, because the peace of mind that you derive that the money is lying in the bank and you can write a check anytime. So the moment you move your money from a savings bank account to a liquid fund, your bank balance gets lower. But your ability to bring that money back from the liquid fund, and that is extremely convenient. It happens with 2 clicks once you have invested through the app, or even otherwise you have invested in a liquid fund and you download the app and pool that money and start using your investment account, your mutual fund investment through that app. Your ability to get that money back in your bank account is effortless. 2 clicks, the amount of money which you choose, and up to 2.5 lakh rupees you get back in your bank account anytime. Sometimes that money gets back hits your bank account in about 5 minutes time. You get an online confirmation. Of course, there are 2-3 things which 2 things needed. One is that you should have a smartphone and you should be able to use the app. And the other is if you don't have the online bank account access, you will not have that privilege. So your ability to move the money from your bank account to the liquid fund is dependent on your having access to your online access to your bank account as well. So these 2 things are needed, and you virtually get effectively that you can get your money back anytime. Assuming that you have few lakh rupees lying in your liquid fund, and you decide to buy something worth 50,000 rupees, and you don't have that money in your bank account. You redeem 50 lakh rupees worth of liquid fund. It hits your bank account, and that money is ready to be withdrawn from your ATM.
And lastly, what about taxation with delay? So interest on bank deposits are taxed as per the slab system. How about the funds?
Yes, there is a small disadvantage for the smallest guy. Interest up to 10,000 rupee on your savings bank account is tax free, and that remains. So if you have 10,000 rupees of interest income on savings bank account, it will remain tax free. When you invest in a liquid fund, it is unlikely to be held for 3 years. You'll be moving back and forth your money into the liquid fund, redeeming it, putting back again. That is the purpose. So all your returns will be taxable. But the key issue is that earning 4% and up to 10,000 rupees is not taxable. Interest beyond that is taxable. Earning more and paying tax is not much of a problem. You definitely earn more, even on a post-tax basis. And the income that is added to your income, it will be taxed at the marginal rate. So I would say that there is absolutely no difference in the taxation for most people earning 30,000-40,000 rupees by way of either return on liquid fund or interest on savings bank account. The treatment is the same. Then the choice should be entirely based on performance. Where can you earn more? Earning more and paying taxes is better than earning less and paying taxes.
Talking about performance today, Shankar Narayan wants to know what are the criteria he should look at while selecting a liquid fund, since their returns are quite similar. And further on, he also wants to know if there is any measure which captures how fast an EMC is allocating and redeeming units.
No, there is. And for his second question, I don't have a clear answer. That how quickly the money is able to, the AMC is able to realize the money and deploy it. And as he has himself, said that the liquid funds don't differ much. They all, deliver return in a very narrow range. They are designed in a manner, and they have to comply with the law in a manner that they tend to invest and generate similar kind of return. You should simply go by the expense ratio. Lower the expense, higher the return, everything else being equal. And that is as much true for liquid fund. And I would expect that some larger fund companies start benefiting, larger liquid fund. There are liquid funds of, there are quite a few liquid funds of over 10,000 crore. And I find that fund companies do not, pass on the benefit of scale of their size to their investors. So I would go by lower expense ratio, and very likely that larger funds will be in a better position to charge less expense, and that is going to be the single biggest determinant or contributor to performance of a liquid fund.
Moving on, Gabor wants to know if arbitrage funds could be a good place to park emergency funds rather than liquid funds. And he says that since they get a superior tax treatment being treated as equity-oriented funds, does that factor come into play?
Yes, but yes and no in a way, but because if you look at liquid fund, your whole objective is to move your money in and out at will on demand, or on based on needs. As compared to that, uh, arbitrage funds do have the character of a liquid fund, though they on the taxation front they qualify or they are eligible to be treated as an equity fund. So it's a good idea. And if there is a small chance that you will end up holding your investment for more than 1 year, arbitrage funds will be very useful, or will be very beneficial, in a sense that all the returns from arbitrage fund held for over 1 year will be completely tax free. But arbitrage funds tend to be little, have not been able to deliver on many occasions, or even returns like liquid fund, because many a times these arbitrage funds, they don't get enough arbitrage opportunity. So their fallback is that they will be an arbitrage fund to the best of their ability, and if they are unable to, then they will behave or they will invest like a liquid fund. So there is a small chance that you choose an arbitrage fund and that the underlying fund becomes a liquid fund. So these are two small risks that you take, but yes, if you are able to choose an arbitrage fund which is able to produce as much return as liquid fund, it will be more rewarding.
Next again, Hari asks if money from liquid funds can be redeemed at any time of the week, since it's not sure exactly when would he need the money. So is this redemption facility available 24/7?
Yes, it is available 24/7 and every day, including the holidays, because the way liquid funds work is you redeem based on previous day's NAV, and because they operate in a manner that there is a reasonable predictability, and it is important for operationally it is possible to redeem your investment only if you have the price of something. So liquid funds, you can take your redemption on a Saturday or a Sunday and the money comes back to you.
Next up again, Varun asks if NRIs are also allowed to invest in liquid funds.
Yes, NRIs are allowed to invest in all mutual funds, including liquid funds.
Moving on, there are a few questions related to the banking accounts remaining. Ajay wants to know why some banks are able to offer 6% interest while others offer only 4%. Isn't there any guidance or regulation around it?
No, the regulations have freed the interest rate on savings bank account, and the larger banks offer 4%. And I see that there is all the big banks offer 4% only. The new and upcoming bank who are looking to attract depositors or small savings account holder with some balances, they are attracting it by offering them higher interest on savings deposit, savings bank account balances. There is a guideline which has actually freed. Earlier there was a guideline where everybody was frozen. So it is good for investors, and the competition is driving new banks, and the banks, even some older banks which want to attract small savings bank account holder with reasonable balances to them. They are offering high returns. So it's simple, market forces at work.
But I guess despite 6% offer from some banks, liquid funds could still make sense, wouldn't they?
Yes, liquid fund will still make sense because I don't see any reason, for somebody who has an app and a smartphone and an online bank and likely to maintain modest balance, should be able to simply optimize return on their investment, and that even on 6%, it is 33% more return. Because if you are able to earn 8% as compared to 6%, it is 33% more return, a third more, which looks quite attractive.
Moving on, Dhiren, Sivan Naresh appears to be quite keen to take advantage of this opportunity that liquid funds are providing. And in fact, he's asking if one should move away from priority bank accounts, which need a balance of at least 2 lakh rupees, and instead move that money to liquid funds.
Depends what kind of privileges your banks are offering and how many of them are you availing. If you think that the privileges offered by the bank is not meant for you, or you don't find them worthwhile, then why opt for it, and why block your 2 lakh rupees in a savings bank low yielding savings bank deposit, a bank balance.
Moving on, Pradeep wants to know your views on ultra short-term bond funds. In fact, Dhiren, for our viewers, if you can demystify the subtle nuances and the differences between a liquid fund and an ultra short-term fund, because they all seem to be too similar.
They look similar, but they are not exactly the same. Ultra short-term bond fund, as classified by Value Research, is what used to be erstwhile Liquid Plus. The regulations about liquid funds became stringent. The SEBI went about specifying the investment norms that the all underlying security in a liquid fund should not be of more than 60-day maturity. Their tax treatment was a little different, the dividend distribution tax. So there were investors who were, that was primarily to drive the safety of by design of these liquid funds. But there are investors who are wanting to have frankly higher return, and they are wanting to assume little higher, maturity, a portfolio of a higher maturity which yields little more. At the same time, keeping the volatility under check. Then even ultra short-term bond fund behave almost like a liquid fund, but they are not compliant with the hard and fast rule of not a single security exceeding 60 days. That's one. So ultra short-term bond fund tend to give little more return than liquid fund. And if you have money which is likely to remain there for a month or 2 months or so, and you are looking at enhancing your return over and above, you want to earn little more than liquid fund. These ultra short-term bond funds have been able to deliver 10% more return than liquid funds in general. So wanting little more return and very some marginal higher risk, of course, lack of regulatory structure that how they will conduct themselves, they are meant for you.
Talking about the long time horizon of investing, as we just mentioned, Dr. Mazumdar wants to know the best type of funds for a time horizon of between 6 months to 3 years.
I would say you have two options. One is if it is tending to be little over 6 months, then go for the ultra short-term bond fund, and you will be reasonably insulated from the volatility of the bonds as well. Even ultra short-term bond fund don't go down in value on a day-to-day basis as much. And if it is tending to be closer to 3 years or 2.5 years, then consider the short-term bond fund. They will be marginally volatile, but they will tend to be you will be still insulated from the risks of what with the kind of experience that you will have with a dynamic bond fund or an income fund. And both the options are likely to give you marginally higher return than the corresponding deposit. And if your investment time frame exceeds 3 years, then the tax efficiency will be an added bonus.
Moving on, Mr. Agarwal has his retirement benefits invested in FDs on which banks deduct TDS. Now he wants to know, is there a way for him to bring his tax on FDs down or on possibly even to zero?
Yeah, he has to give a declaration. If he is not a taxpayer, then he has to file a return and claim a refund. And before that, if you can actually give a declaration, I don't remember the exact form number which has to be filled for taxation compliance, but if you can give a declaration that he is not a taxpayer and all his income aggregated will be lower than all his interest income and all his income put together will be lower than that, then the bank will exempt him from deducting the tax.
Our next viewer wants to know if he will have to pay capital gains tax on his debt funds, even if he has not withdrawn any money from them. So again, the benchmark being bank FDs. Now, even if the FD doesn't mature, people still have to pay the tax on the interest. So that's where I think their disconnect is. If you can clarify that.
Yeah, that's a huge advantage of mutual fund. If you invest in the growth plan of a debt fund, and if you don't do any transaction, you are not liable for any tax. You are liable for tax only when you do the transaction and you book a profit. And if you invest in in a debt fund, you hold it for 3 years and more, and you uh, so one is very clear that you are not liable for paying any taxes in case of deposits or bonds. Even in a cumulative plan, all your the income that is accruing to you will be taxable. You have to actually disclose it that you have earned it though not realized it. In case of mutual fund, till you don't realize it, you don't have to pay anything. Then if you hold it for 3 years, you are liable for capital gains tax, but post indexation, which means you will hold a bond fund for 3 years, and after indexation your profit will be calculated, and depending on the capital gains, post indexation, after adjusting for that inflation, then you will be liable for paying 20% tax on the capital gains, which is also lower than the highest tax bracket.
Moving to a slightly different topic, Nilesh asks whether ETF is better than a mutual fund for medium to long term.
Sorry, I didn't catch you. Against what?
ETFs.
ETF.
He wants to know your views on ETF versus a mutual fund.
Most ETFs are mounted on an index, and the case for index in the investing in India is not very strong. But if one is choosing between an index fund versus ETF of the corresponding of the same index, then ETF is a better way because most ETFs are cheaper. But you have one or two difference as compared to the way you buy mutual fund is very different from ETF. You buy mutual fund based on end of the day's NAV. You fill up a form or buy online, buy direct. Unlike that, the ETF, you buy it like a stock. You place the order with the stockbroker or an online broker, and the price of when you buy a mutual fund, everybody gets that day's mutual fund at the same price. In case of ETF, it depends. There is a element of demand and supply at that given point when you buy, and the ETF can be bought or sold not necessarily at the NAV but at the market price, which can vary from the NAV. That part, I think, the case for indexing hasn't taken off, so ETFs have not been in ETFs as well as index funds have not been very popular in India.
Next up, Mr. Amit would like you to recommend a good Sharia fund for him.
There are 2-3 options here, and Sharia funds try and comply with the Sharia investment philosophy or principles that companies should not have significant borrowing, or they should not be big lenders. So Sharia funds definitely don't invest in banks. Even the company and some of the unethical businesses, so alcohol, gambling, and all those things are barred from such investment framework. 3 investment options. One is run by erstwhile Goldman Sachs, which is now a Reliance company, Sharia ETF. The other one is a Tata Ethical Fund, and Taurus Mutual Fund also offers a Sharia compliant ethical fund.
Next up here, Amit wants to know what proportion of gold should one have in an aggressive portfolio, and further on he asks if it's better to hold in physical form instead of paying an expense ratio of 1% for gold.
One should not own any gold in any growth oriented investment, because gold has been has been in the limelight for last 4 or 5 years for a variety of other reasons, but for growth and for very accidental reason. Some people have the impression that gold has been a very high performance investment. Gold is not an investment. The damn thing sits there in your locker. It doesn't produce anything, so you should not consider it as an investment. And just in case you must invest in gold, or you think you should have a certain part of it, and most Indians, the form in which they actually own gold is consumption. You keep it in the locker. I haven't come across too many people who actually sell it in a crisis. And if at all you look at it, I think the best form in which you should have ownership of gold is sovereign gold bonds. Not only they provide you the return provided, or I would say that there could be an appreciation or a depreciation in the worth of value of gold, but they will exactly provide you that plus 4% more interest. And on the safety front, you have absolutely nothing to worry because it is offered by Government of India. And safety, security, and you don't even have to preserve it. It is the finest financial form, because any other form that you keep in will have an expense. If you keep it in the form of a coin, if you keep it in the form of a jewelry, it will have the making charges. Maybe 15-20% of your investment of the worth disappears in the form in which you keep it. If you keep it in coin, it is illiquid, and there could be some handling cost. If you have it in the form of an ETF, it will have 0.5% to 1% expense ratio. If you have a gold fund, which is an open-end fund which invests in the ETF, it will have a 1.5% cost. As compared to all these costly ways of holding gold, sovereign gold bonds will actually get you gold plus 4%.
Our next question comes from Mr. Chopra, who has retired recently, and in fact he received his superannuation amount just before 8th of November when demonetization was announced. And now with all his retirement accumulations in bank, he wants to know what can he do with it to earn regular monthly income.
Good that he has got all his money, superannuation benefits credited to his bank. Good that he has no cash. So demonetization or no demonetization, it doesn't matter to him. Yes, demonetization might have caused an anxiety. The first lesson he should take is that not take out as much cash from his bank account beyond what is needed. I think it's a very important money because his potential income in future has come down. So even his mental framework of his risk appetite, his approach to his ability to assume risk would have gone down. Most important thing, he should do a very careful evaluation that how much monthly income he requires from his investment, and he should look at all the other income avenues he has. Will he be getting some pension? Will he have some rental income? So he should do some budgeting of he should budget for his monthly income requirement and invest in fixed income alternatives to the extent that much income will be produced for next 2-3 years. That is one way of doing it. And rest of the money should be invested conservatively. This is the simplest plan which anybody retiring with a large amount of superannuation accumulation should have in mind. Then there are variations of this model. One is that the money that you are likely to consume based on the budget monthly income requirement budget, the next 3 years income should be put in a reasonably liquid form. Maybe in 6 months requirement should be put in a deposit, should be kept in the savings bank account or a liquid fund, or maybe 3 years income requirement should be kept in an ultra short term bond fund, and you start redeeming your monthly requirement from that money. Remaining money should be invested conservatively. Then you will be able to ensure. And why it should be invested conservatively in a growth vehicle, maybe a balanced fund or some allocation to equity as well, depending on your risk tolerance, because it is very important to protect the value of your capital. Because assuming that you have 50 lakh rupees and your investments will generate 10% return, which means you will generate about 5 lakh rupees a year. And if you keep consuming the 5 lakh rupees a year income from your investment, then 5 years down the line, you will have a problem, because your need for income will be higher while your 50 lakh rupees has remained constant. So it is very important for people retiring to invest a part of their money in a manner which will ensure that your capital also appreciates, because with inflation, your need for income will rise. And it is crucial that you invest a reasonable part of your money in a manner which will lead to supplementing your capital for income in future.
We take the last question for today's session, Devi. Ketan asks that with the US rates going up, is it a good time to invest in dynamic bond funds?
US rates going up or down will have some bearing, but I don't know. You should be investing in dynamic bond fund for one reason, that in India the outlook for interest rate is very clear. It will go down. It has not gone down in a hurry. It has not gone down in the last monetary policy announcement, but the result of demonetization, result of lower inflation, result of collapse in demand, and in recent past makes me think that interest rate will have only way to go, which is go down. And dynamic bond fund will be a key beneficiary of this, and they have in fact benefited a lot in the recent past. If you look at last 1 year return, the band of return from the dynamic bond fund is in the region of 14 to 17%, which is quite high. And I think this will continue for next 1.5 years till the rate cuts expectation continues or it happens. So don't take, the US rate hike is one issue. It will have, it will cause turbulence. It will be very noisy. It will have an impact even on the Indian market, because many FIs now invest in Indian bonds as well, and a certain withdrawal can actually have can be little disruptive. But beyond that, I think the reason to invest in dynamic bond fund now for next 2-3 years is primarily because they will be the best yielding fixed income avenue.
Thanks for sharing your views.
Thank you.
Any parting advice for our viewers?
Make your idle money work harder. Don't leave money on the table. It doesn't cost a serious effort. You will actually take great pride in optimizing your return, which was otherwise sleeping in your bank account. And it's easy. Yeah, if you try it once, it's fun doing it.
Thanks, Sid, and thanks everyone for joining in. Don't forget to join in next week when Mr. Prasad Dhonde from Birla Sun Life Mutual Fund, he's a veteran fixed income fund manager, and he'll be joining us to talk about fixed income strategies in a low rate environment. Thank you.